book or not to book profit is the question that many investors are asking today as Indian stock market gives mouth-watering returns. Today we have with us Mr. Vijay Kuppa, CEO InCred Money, to throw light on what is profit booking, when to book profit, how to book profit, the strategies, and of course the mistakes to avoid, and much more. Welcome to Business Standard, Mr. Kuppa. Thank you so much for joining us today, Vijay Kuppa, CEO InCred Money.
Thank you. Thank you for having me.
Yeah. So, Vijay, my first question is, obviously the markets have given mouth-watering returns, and people have already booked profits, and there are a lot of people who will be booking profits. So, if you can help our viewers understand, when is the right time to book the profit?
Okay. There are actually two different schools of thought. There is one school of thought that says that you should not book profit in the sense that you should ride out equity over a period of time as
Mhm.
long as the fundamentals and the long-term picture is intact.
Mhm.
And you hear of a lot of these, stories from the old timers who say that the real wealth is created when you enter a good stock at a certain price and you hold it for a really long time and it goes up. So that is one school of thought. The other school of thought is that you should book your profit time to time. And depending on when to book depends on a lot of factors, including your investment goals. So you're investing towards a specific target, you want to achieve a certain corpus and you want to do it. It could also be based on your risk tolerance. So you have a certain risk appetite and you feel that, okay, the market, like what people are saying is that the market today, especially in the mid and small cap space, is overvalued. So when it crosses your comfort zone, then you should book your profit. Another reason to do it is that maybe the overall global macroeconomy is changing. So market conditions are changing. Maybe there is a global slowdown. And then you should book profit. So there are two, three different factors that you need to consider when to book profits. First, I would say is when if you have a certain target in mind on a particular stock or on a particular sector, that you feel that it has reached its price, then it's always good to book some profit and take some money off the table. Or if you feel that the fundamentals have deteriorated. So if you like a particular stock, but you feel there is a management change, you feel there is some business outlook change, and you feel that it is not right because there are a lot of opportunities that this market will give you. So it's always not necessary to remain invested. You could go in and out as per your convenience. The second reason is on rebalancing. So very simply, maybe say a couple of years back, somebody started with a 50-50 debt equity asset allocation mix.
Mm-hmm.
Now, just that the equity itself has doubled. So that doubling itself moves your asset allocation from 50-50 to 75-25, just because your equity has doubled. So now it is more equity, less debt, if you look at an overall pool, because your market price has changed. So rebalancing means you now sell some equity, bring it back into invest in debt and bring it asset allocation back to an old level. So this is called booking profit for rebalancing. The third is based on the market conditions that I spoke earlier, that you think something fundamentally has changed. And fourth is if you have invested for a goal. So suppose you've invested to, say, go on a vacation, or you've invested for a wedding in the family, or you invested for an education goal. Once that is reached and you have a use of spend, then I always recommend that you should book some amount and do that, because finally investing is to have a good life and you should always look to book it to enjoy your life on the side. So these are some reasons why you should book your profits.
Right. So now we've understood the reasons why to book profit, but if you can help us with some strategies on how to book profit.
So how, as in, so there are a couple of ways in which you can think about it. One is, of course, at one end of the spectrum, complete sale. So whatever
Mm-hmm.
is your position, you look to exit it completely, bring it down to zero, and maybe look to enter back again.
Mm-hmm.
Now, this style suits maybe somebody who's in futures and options, who's a little more aggressive trader, or it suits somebody who's a little more experienced, because exiting at a certain price is also an art, and you need to know maybe you have underbooked it or maybe you have waited a little long. So it's not so easy to determine when to completely do it, but that is one approach. The second approach, which is a more mixed approach, is that you start exiting systematically. So for example, you exit 20% at a time at different levels. So maybe somebody would have thought that 20,000 of the Nifty was a top, so I'll book some there, but it has gone to 21, then you book, now it has gone to 22. Even now, if you ask, somebody may say maybe it will go to 23,000 or 24,000. But so let me start booking systematically and keep taking money out of table. So you have like an averaged cost of exit. That is one more approach to kind of do it. The third reason why how you can do it is when you optimize it for tax. So as you know, there is a long-term capital gains tax depending on your holding period. Short term of 15% if holding is under 1 year, or long term of 10% if your holding is above 1 year. Now, there is also a provision that up to 1 lakh worth of gains is tax exempt. So, based on that, every year you should see that you at least book 1 lakh worth of gains, provided it falls into your profit booking criteria, such that you're able to also save tax on that. So, these are the three ways: one, full sale; one, partial sale systematically; and third is optimize for tax.
Right, right. Also, if you can throw some light on the common mistakes that people make, especially lay investors who've entered the stock market, especially in 2020, and now seen, tremendous rise in their equity
Right.
portfolio. So what are the common mistakes or pitfalls that they may be, making right now while
Right.
booking profits?
So I think the biggest thing is that because they entered in 2020, they've only seen the good side of the market. They haven't seen how volatile it can be. And hence, it also makes a lot of people think that making money is easy. I'm
Mm,
sure it is easier than maybe some of the other things, but it's not that easy also. And hence, because you're getting such good gains in such a short span of time, expecting that it is going to continue in a similar manner, say over the next year or two, I think that may be a little aggressive. So the first mistake people do is thinking that nothing can go wrong. I think a lot of things can go wrong. It need not go wrong today, but at least you should be aware that things could go wrong and accordingly take your decision. So that is the first thing. The second mistake that they do, and that's more tactical, is again that all or nothing. What I had mentioned earlier, that
mm,
you want to book it, you book it, but unless you're very sure of what you're doing, you should probably do it in a more systematic manner. But if you're confident and you're willing to take that chance, because it could work out both ways. Maybe you get a top and you are booked completely at the top, but maybe you have underbooked it as well. So that all or nothing is also, for an average investor, I would recommend that do more systematically. And the third is that after you book your profit, what you do with that money. So
mm,
often it's not just booking, but also remaining invested for long periods of time, because idle money doesn't earn you anything. You have to, one, at least beat inflation, and two, you have to earn whatever expected rate of return that you do. So always keep a redeployment plan in place, that whenever you book it and money is coming into your bank, you have something to do with it, because idle money either doesn't earn or may get spent in not a very productive manner. So better to have a plan that, okay, I book it from equities, I can put it into a bonds, or I can put it into liquid funds, or I put it into something while I look for the next move. So three things: that one, it's not always going to be such a great ride. You have to be
mm.
careful that maybe markets could turn and you may not have these much profits that you're holding on to. Second, all or nothing. Don't have to look at it that way. You can do it more systematically. And third, keep a redeployment plan in place.
Right, right. And my final question is, obviously, if you can give a more general advice on profit booking and investments, keeping in mind that this is January and we have another year ahead of us. Yeah.
Yeah. So actually, profit booking is really an art, and it is a very
Mm,
difficult decision. It's not an easy decision.
mm,
It's probably tougher than even buying, because
mm,
you really don't know what the future is,
mm,
and it's really a balancing act. It's like to book or not to book.
mm,
That is the question. So whether to do it. I think, and there is an element. So everybody worries between greed and fear, the two biggest emotions
mm,
in the markets.
mm,
One, if you ask somebody to book now, there is a greed that, what, it's come so far, could it go higher? And
mm,
second, there is a fear. I've made so much, because people start calculating the gains that they have made, right?
mm,
That
mm,
plays in the mind. And what if this goes away? If it falls down, then I lose out what I already have. So
mm,
it's always a balance between this greed and fear. So I would say that, be systematic in your booking and have a redeployment plan. So that you should definitely do. Second is, you should also try to look at some other different instruments that offer you principal protection, also that offer you some upside also. So there are a few, like for example, a market linked debenture. Maybe that is something that you can consider, which also gives you the upside, but also principal protections. Doing that.
mm,
Third, don't be emotional when you're in the markets. That's the first thing that you will learn. And for a lot of the people who have seen cycles, they realize this. But people who have only seen a bull cycle, they don't. And the learning market teaches you quite tough lessons. So if you feel like booking it, always book your profit, because money in the bag is worth a lot more than just money on paper in the market.
mm,
And of course, look at tax and prioritize, your tax planning. Do it well. so that you're also able to get some additional gains from that tax. So small things like this, if people do when it comes to their stock market investments or their mutual fund investments, they'll make a lot more returns on an overall basis.
Okay. Okay. Thank you so much. And I like the way you said to book or not to book. That is the question. Uh, and that truly is a question for many people. And those who will choose to book, I'm sure this video and all the things that you've explained, it will definitely help them to make a wiser decision. Thank you so much, Vijay, for joining us today.
Thank you so much, Bindisha. Thank you so much for having me.